wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 214. And in this episode, we're reviewing the performance of the financial markets during the 21st week of 2026. And that is from Monday the 25th to Friday the 29th of May. And without further ado, this is your host, Jamuhuri. And together, let's dive right in. We kick it off in the United States, where fresh economic data from the Commerce Department highlights a challenging mix of persistent inflation and slowing economic growth, fueling concerns of a stagflation environment. In April, the Federal Reserve's preferred inflation gauge, the Personal Consumption Expenditures Price Index, rose by a seasonally adjusted 0.4%, and this push lifted the annual headline inflation rate to 3.8%, matching the Dow Jones forecast, but marking its highest level since May 2023. These ongoing price pressures are expected to keep the central bank from cutting interest rates in the near future. On a more helpful note, the Core PCE data, which excludes volatile food and energy costs to better track longer-term trends, grew by a softer than expected 0.2% for the month. And although this brought the annual core inflation rate to 3.3%, which is its highest level since November 2023, the mild monthly increase suggests that the intense price pressures of early 2026 may be beginning to cool off. However, the inflation battle is complicated by a sharp downgrade in economic momentum. A revised reading revealed that the gross domestic product for the first quarter of 2026 grew at an annualized rate of just 1.6%, which was a significant drop from the government's initial estimate for a growth of 2%. This combination of cooling growth and stubborn price pressures leaves the U.S. economy navigating a delicate path going forward. On Wall Street this past week, U.S. stocks closed at record highs on Friday, capping off a winning week and a month driven by a tech sector boost and falling crude oil prices. Market optimism was further fueled by a geopolitical catalyst as the U.S. and Iran agreed to a 60-day memorandum of understanding to extend their current ceasefire. During Friday's trading session, all the three major indices hit fresh all-time intraday highs, with the Dow Jones Industrial Average jumping by 363 points to close at 51,032, whilst the S&P 500 rose by 0.22% to end at 7,580, and the Nasdaq Composite ticked up by 0.2% to settle at 26,972. This strong finish solidified substantial weekly and monthly gains across the board, and for the week, the Nasdaq led with a 2% gain, followed by the S&P 500, which was up by more than 1%, and the Dow Jones Industrial Average, which ticked up by less than 1%. However, for the full month of May, the tech-heavy Nasdaq Composite completely outperformed its peers with a spectacular surge of 8%, whilst the S&P and the Dow posted impressive gains of 5% and 3% respectively. In the US government bond market, Treasury yields held steady on Friday as investors paused to evaluate evolving Middle East developments on the final day of trading of the month, particularly following signs that a lasting ceasefire agreement between the US and Iran may be within reach. This calm followed a busier Thursday session where borrowing costs had declined across the board, and on Thursday, energy prices dipped on reports that Washington and Tehran had largely finalized terms of a 60-day memorandum of understanding to extend their current ceasefire, which in turn pulled down the 10-year yield down by more than 3 basis points. By the end of the week, yields rested at slightly lower levels, with the yield on the 2-year Treasury note, which closely tracks investor expectations regarding short-term Federal Reserve interest rate policy, eased by more than 1 basis point to settle at 4.008%. Similarly, the yield on the 10-year Treasury bond, which is a crucial benchmark that directly influences consumer borrowing costs like mortgages, auto loans, and credit card debt, also ticked down by more than a basis point to finish at 4.443%. And just for your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, crude oil prices plummeted in May, driven by growing optimism that a diplomatic breakthrough between the United States and Iran could soon reopen the strategically vital Strait of Hormuz. Market sentiment shifted dramatically after U.S. officials revealed that negotiators had hammered out a tentative 60-day memorandum of understanding to extend an existing ceasefire and initiate talks regarding Iran's nuclear program. This wave of geopolitical relief triggered the worst monthly performance for global energy benchmarks during the year. The international benchmark Brent crude plunged more than 19% over the course of May, marking its steepest monthly decline since the onset of the COVID-19 pandemic in March 2020. Similarly, the U.S. benchmark West Texas Intermediate crude shed nearly 17% of its value during the month, recording its weakest performance since April 2025. The downward trajectory sustained itself through the final day of trading of the month on Friday, with prices sliding further following President Trump's announcement that he would convene a meeting to make a final determination on the proposed agreement with Iranian leadership. By Friday's closing bell, West Texas Intermediate crude had dropped an additional 1.73% to settle at $87.36 per barrel, whilst the international benchmark Brent crude fell by 1.77% to close out the month at $92.05 per barrel. In the precious metals market, gold prices closed higher on Friday, marking a second consecutive winning session as investors reacted to potential diplomatic breakthroughs in the Middle East. Sentiment shifted positively following news that the United States and Iran may have agreed to a 60-day extension of their current ceasefire, a deal which would crucially lift restrictions on shipping through the Strait of Hormuz. However, the agreement is not yet set in stone, as President Trump has yet to officially approve the terms, and Iran's state media cautioned that the deal has not been fully finalized. Despite this brief Friday rally, gold prices still suffered a broader monthly decline, heavily weighed down by a higher for longer interest rate environment. This economic pressure was reinforced on Thursday by fresh data showing that U.S. inflation surged in April at its fastest pace in 3 years. This spike in inflation was driven by higher energy prices directly linked to the conflict with Iran, strengthening expectations that the Federal Reserve will feel compelled to keep interest rates unchanged well into next year. And because gold is a non-yielding asset, higher interest rates naturally increase the opportunity cost of holding this asset, making it less attractive to investors. This intense inflation and interest rate concerns ultimately shaped gold's performance for the month of May, leaving spot gold down by more than 2%. This downward pressure forced gold to tumble to a 2-month low of $4,365 an ounce on Thursday. However, the substantial geopolitical optimism sparked a late-week recovery, allowing spot gold to climb 0.6% on Friday and to finish trading the week at $4,519 per ounce. In the cryptocurrency market, Bitcoin clawed back its recent losses to trade near $74,000 on Friday, effectively erasing a multi-day slide. This sudden rebound came in response to a major geopolitical announcement from President Trump, who abruptly declared an end to the U.S. naval blockade of the Strait of Hormuz, easing weeks of severe pressure on both the cryptocurrency and global oil markets. This dramatic shift marks the end of a highly volatile period for Bitcoin, which had been repeatedly whipsawed by the Middle Eastern standoff since early April. The tension peaked in mid-April when Trump first ordered the blockade, and at that time, global oil prices spiked on fears that 20% of global seaborne crude could be choked off, causing Bitcoin to plunge towards $71,000 as investors pulled away from riskier assets. And as the standoff dragged on, the market found some stability when Washington clarified that the blockade would be partial rather than absolute, insisting that freedom of navigation would be preserved for non-Iranian vessels. This distinction initially helped Bitcoin bounce back above $72,000, setting the stage for Friday's full recovery to the $74,000 level once the blockade was lifted entirely. We now change scene to the Kenyan financial markets, and we start by looking at the cost of living in Kenya, where Kenya's rate of inflation accelerated sharply for the second consecutive month in May 2026, reaching 6.7% year-on-year, up from 5.6% in April. According to the Kenyan National Bureau of Statistics, this marks the highest inflation rate that the country has seen since January 2024. The sudden spike is primarily driven by rising global energy prices and the consequent increase in domestic fuel prices stemming from the ongoing war in Iran. The inflationary surge was felt most acutely across two major household spending categories. The first is transport, which led the overall acceleration, jumping dramatically from 10% in April to 16.5% in May, following consecutive fuel hikes in April and May. The second category is food, where food and non-alcoholic beverages continued to edge upwards, climbing to 9.4% from 8.8% the previous month. And with headline inflation now threatening to breach the upper limit of the central bank's target range of between 2.5% to 7.5%, pressure is mounting on financial policymakers. This data arrives just days before the central bank's Monetary Policy Committee meets on Tuesday, the 9th of June. After opting to keep the benchmark interest rate unchanged during the last policy meeting in April, committee members must now decide whether a rate hike is necessary in order to rein in escalating prices. And in related news, after a prolonged period of easing monetary policy, the Central Bank of Kenya recently paused its cycle of 10 consecutive rate cuts, holding the benchmark lending rate steady at 8.75% at its April meeting. This pause was enacted to monitor the secondary effects of skyrocketing global energy prices triggered by the Iran war. The urgency behind this decision became clear when April's inflation rate surged at its quickest pace in 7 years, climbing sharply to 5.6% from 4.4%. as the global oil price shock began to impact the domestic economy. In response to this intensifying inflation spike and emerging pressures on the Kenya shilling, commercial banks now expect the central bank to raise its benchmark rate for the first time since February 2024. The Kenya Bankers Association, which is a primary banking sector lobby, anticipates that the central bank's Monetary Policy Committee will officially implement this rate increase during its upcoming meeting on the 9th of June. This anticipated policy shift will have immediate and widespread consequences for the financial sector, the first being higher borrowing costs, as the benchmark rate hike will trigger an increase in consumer loan rates. And the second is reduced loan demand and defaults, as the banking lobby is deeply concerned about weaker consumer purchasing power as the cost of living continues to escalate. Bankers warn that this combination of squeezed household budgets and more expensive credit will dampen overall demand for new loans and likely lead to a rise in loan defaults. Over to the domestic foreign exchange market, where during the past week the Kenya shilling held steady versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.52 compared to a rate of 129.57 that was recorded the previous week. Meanwhile, the sterling pound was priced at 174.43 and the euro was valued at 150.60. And on the regional front, one Kenya shilling was changing hands for 29.12 Ugandan shillings and 20.22 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.29. With regards to the exchange rate, the IMF has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves remained relatively unchanged for a grand total of $13.20 billion, which is equivalent to 5.6 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default, which the country came close to in June 2024 with the maturity of Kenya's debut Eurobond for $2 billion. In the money markets, during the past week, the interbank market was sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya Shilling Overnight Interbank Average, aka Kesonia, this is the rate that banks used to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the central bank rate at the same rate. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this amount averaged at around 13.6 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 28th of May, and the central bank received bids totaling to 16.6 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 69%. The central bank accepted almost the entire amount of bids received, and the results of the auction were as follows. The 91-day rate finally plateaued at 8.38%, whilst the 182-day rate ticked up by about 4 basis points to close at 8.25%, and the 364-day rate also inched up by about 4 basis points to settle at 8.62%. Over the past 4 weeks, the yield on the short end of the Treasury bill market has been rising steadily, and this is on the back of the first supplementary budget for 2025-2026, which pointed to a massive increase in the domestic borrowing target of about 360 billion shillings. In addition to that, the latest data shows that inflation is now trending higher, mainly due to the impact of rising fuel prices. We should therefore expect more upward pressure on interest rates as investors park their funds into the 91-day Treasury bill, which gives them an opportunity to reinvest at a higher rate in the short term. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent for the Republic of Kenya, is now inviting bids for 2 reopened fixed coupon treasury bonds in which it is looking to raise a total of 40 billion shillings for the stated purpose of budgetary support. The terms and conditions of these 2 bonds are as follows. The first bond is a 15-year bond that was initially issued in 2020 and now has 8.7 years left to maturity. This bond matures in February 2035 and has a coupon rate of 12.75%. And for the second bond, this is a 25-year bond that was initially issued in 2018 and now has 17.1 years left to maturity. This bond matures in May 2043 and has a coupon rate of 13.40%. Please note that these bonds are now open for sale until Wednesday, the 3rd of June, when the auction will be held. On Kenya's national debt, according to the latest data from the central bank, Kenya's national debt as at March 2026 stood at 12.83 trillion shillings, which was divided between domestic debt, which stood at 7.14 trillion shillings, and foreign external debt that is valued at $43.74 billion, which is equivalent to 5.68 trillion shillings. A recent debt sustainability analysis described Kenya's debt as manageable, but also highlighted a high risk of debt distress. In response to this, the National Treasury has developed a medium-term debt management strategy that aims to reduce the debt to GDP ratio from 70% down to 57% by 2028. And just for your information, Kenya's debt ceiling limit was converted to a debt anchor that is now set at 55% of the country's gross domestic product. And given that our current debt to GDP ratio is estimated at about 70%, this means that the government is in breach of its own borrowing target. Up next is our topical issue. And this week we are looking at two issues. The first issue is on a court ruling that compels the Kenyan government to disclose details of the standard gauge railway project. The Court of Appeal recently upheld a landmark ruling compelling the Kenyan government to publicly disclose confidential contracts and loan agreements for the standard gauge railway project. In doing so, the appeals court dismissed a bid by the Attorney General to block the disclosure, effectively enforcing a May 2022 High Court decision that ordered the secret documents to be released to the public. The legal battle centers on the massive Mombasa-Nairobi railway project, which cost over $4.5 billion and is backed by Kenyan taxpayers. This project was heavily financed through substantial loans from the Export-Import Bank of China. Crucially, the agreement signed between Kenya and these Chinese banks included strict confidentiality clauses explicitly designed to keep the specific loan terms and conditions hidden from public view. State lawyers repeatedly warned the courts against ordering the disclosure of these records, highlighting that making them public would directly violate the signed confidentiality agreements. And the second issue is on missed revenue targets by the Kenya Revenue Authority. The Kenya Revenue Authority is facing a worsening revenue shortfall, missing its tax collection target by a substantial 162 billion shillings through the 5 months of the fiscal year ending March 2026. According to the National Treasury's latest quarterly economic and budget review report, ordinary revenue collections reached 1.81 trillion shillings against a projected target of 1.98 trillion shillings. This represents a widening deficit, growing from a collection gap of 110 billion shillings previously recorded at the end of December 2025. This deterioration in revenue performance comes as a direct result of emergency tax concessions granted by the government. In an effort to shield the domestic economy and consumers from the severe global impacts of the US-Israel war on Iran, the government introduced relief measures, most notably halving the value-added tax on petroleum products. Looking ahead, the Kenya Revenue Authority's revenue performance risks worsening even further. On top of the existing shortfall caused by the fuel tax relief, the tax authority is facing mounting pressure to introduce additional tax cuts on other primary income streams, specifically the pay-as-you-earn income taxes. Implementing these cuts could severely complicate the government's ability to close its budget deficit. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamhuri@gmail.com. Jamhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember that courage is not the absence of fear, but the triumph over it. A quote by Nelson Mandela. Think about it. Thank you, and God bless.